It is once again time for our weekly market review, and I know a lot of you have been waiting for this because you've been making comments under the videos, YouTube comment section. I don't know why I'm over explaining that, but you've been saying that you feel uneasy about the market, and I'll tell you right now, you're not alone. You're gonna see why in this video. And we're also gonna talk about a few recession indicators that may be popping off, because that's a real hot topic right now as well. Everyone thinks a recession is coming, and a lot of people think we're already in a recession. And obviously recessions are no good for you and me, so we're going to talk about that too. But before we get into the market review, there's something else extremely important that I want to talk to you about, and that is Top Gun 2. We were talking about it last week, and I finally saw it this weekend, and let me tell you, it lives up to the hype. And there was a lot of hype for this movie, especially coming from me. I was telling everyone about it, and I didn't even see it yet. I was just trusting in Tom Cruise. And sure enough, the movie was incredible. But I'll be honest with you, the first half wasn't looking too great. It was a pleasant movie, but I was like, oh, this isn't the high octane action that I signed up for. That was gonna blow me out of my seat. But then the second half, that was crazy. And I'm telling you about this because you only have a few days left to see it in the big IMAX theater with the great sound and everything, because that's how it's made to be watched. With the sound and the jets, and it's crazy. And you only got a few days left because Jurassic Park is coming to theaters this Friday, I think. And that's gonna take over all the big screens away from Top Gun. And you will be very sad if you miss this movie. It is so much better than all the superhero trash that we get nonstop now. And I know you guys come and watch these videos not to understand what's going on in the stock market, but to get movie recommendations. So I'm gonna give you one more before we get into the market review. Just real fast, this movie, Everything Everywhere All at Once, incredible movie. I would even say it might be a perfectly made movie, which is very tough to do. But this one is coming out on streaming very soon this month, and you should definitely watch it. So Top Gun 2 and Everything Everywhere All at Once, those are the best two movies of this year so far, and I doubt anything will top them. And okay, now that I'm done telling you how to live your life and what movies to go see, let's get into this market review. And as always, it's coming from MacroOps, our global macro research and consulting firm. So first up is Bank of America's recent flow show. And the first thing I want to point out is what a bear rally is. Because we've been talking about this, right? This recent rally that we had, we know that it might be an intermediate bottom, but in the long term, we're still in this sideways regime, sideways to down really. Meaning that yeah, we might have this short-term bottom, but what likely is gonna happen is that we're gonna go back up a bit and then turn around and make a lower low. Now when we're talking about this part where we go back up a bit, how much is that? What does that mean? Well, the back up a bit is a bear market rally, and you can see bear rallies in 2000 and 2002 saw a minimum of an 18% gain, which is a lot, right? And that's the tricky thing about a bear rally, because if the entire market is up 18%, what are you gonna think? You're gonna think we're back in a bull market. And that's what makes it so brutal. If you invest too much and you don't have risk control in place, the market turns around yet again and even more people are hurt. You gotta think about it like you're laying on the ground and Mr. Market is kicking you. First kick sucks, second kick is even worse. Third kick, at that point you just wanna die. Because it just gets worse and worse. And that's how the market works, right? To get a real bottom, you gotta have total despair. And the best way to torture someone is to give them just a little bit of hope, like a bear market rally, and then take it all away and make it worse than it was. And that person is gonna be hurting even more than if you didn't give them the hope. And that's the sick truth of bear market rallies. So just keep that in mind as we see this market rallying. And you can see it's already paused a bit. That doesn't mean that we're gonna turn around right here. We might, but we also got a good chance to keep going. And you'll see why as we continue to go through this data. So the Bank of America bull and bear indicator fell even lower last week. Or I should say last week it was 0.6 and now it's 0.4. And so it's a contra signal with sentiment, right? The more bearish people are, the more bullish that is for the market. For the same reason that we just talked about with you laying on the floor in the market kicking you. Because we know with sentiment and positioning, once people are super bearish, they have all the cash on the sidelines. And there's only one place for that cash to go, right? Back into the market when they start buying again. So that's why you want to look for that total desperation and sellout, capitulation as we've been calling it, before we know a real bottom is in. So right here, we keep looking at this indicator because that's telling us, yes, extreme bearishness, that's a buy signal. That means we might be at a bottom, which we've already talked about. Here's another interesting factor though about oil. We've had 108% gain year over year since last year to now. And you guys have felt that at the pump, right? Gas prices here in Detroit Detroit are like over $5. It cost me $70 to fill up the tank. And $70 is a lot. Fortunately, I'm okay, but for most people, that's a huge cost that you couldn't budget for. It can break your bank, honestly. So huge increases in the price of oil tend to precede and partly cause bear markets. And that's for the exact reason that we're talking about, right? And a lot of you have brought this up in the comments. Because if people are paying so much for gas, they don't have that money to spend on other stuff, which in turn affects earnings of companies, right? Because the customers can't afford it. And those earnings go down, and then what happens? It's all a giant cycle until we're in a bear market and recession. And that recession indicator that we're talking about, it has to do with exactly that, which we're going to see in a second here. But this 108% gain year over year is absolutely huge. The only time it was surpassed was in 99 and 74. And you know, the 70s was a wild time with the commodities boom and all that. So they had that first oil shock, and that's what caused the huge rise in prices. And then 99 was the dot-com bubble. So this is not a good look that we're having it happen again in 2022. So this is what we do in our research, right? This thing trying to predict the market, it's not cut and dry. And honestly, trying to predict it makes you an idiot because you really can't predict it. All you can do is pretty much play what's in front of you. So why is this channel called Fallible? Well, that's because as a team, what we do is we keep our mind open to new incoming information. And we constantly change what we're thinking based off that information. Which I'll tell you, that doesn't do you any favors in the publishing space. Because the best people with the best newsletters are making the stupid bull claims that they stick to for years. If you got a guy writing a newsletter or having a YouTube channel saying that a crash is always coming, they've been saying that from 2009 and they're gonna continue saying that forever. But in our case, because we're actually trading and managing real money, we can't stick to some stupid prediction just to sell subscriptions. We actually gotta change to what's actually happening so we could be successful in the market. A lot of the people with the newsletters, and I'm saying newsletters here because that's where some of the biggest guys are, but YouTube too, they just stick to that prediction because it works better for publishing. We can't do that. So that's why if you feel a little frustrated when we look at all these data points, one says bullish, one says bearish, it's okay to be frustrated. That's just how the market works. And we're not gonna change it. There's no way to change it. You just gotta live with it. That's the game we signed up to play. And actually a lot of us didn't sign up to play it, but you know, our retirement goes somewhere, right? Which is also why you know that I prefer systems, because there's so many this and that and it's all wishy-washy. I at least like having a system for risk control. So I know exactly when to buy, when to sell, and what my returns should generally be when you have a solid back-tested system with a real reason backing it. In our case, momentum for the Fallible system. And we know momentum has worked for hundreds of years and it will continue to work. But anyway, moving on, the small cap space has some of the most constructed charts around right now. Why? Because they've been beaten down worse than anybody. You could see their valuations relative to the S&P 500 are lower than they've ever been in a very long time. And you know, in all these videos that we've been doing recently, we've been talking about these spaces that are really beaten down for this reason. There's only a few times where you get opportunities like this. Because most of the time when the market is moving up and everything's moving together, you're not going to find anything that's that different. In this case though, like when valuations are so low, you could definitely find a lot of good small caps. And you're going to see us dig into more of those in the months to come. And of course, I'll be making videos about it. See, I love my job because Alex and Brandon, they do all the work and then I just sit here and tell you guys about it. So if we're looking at the overall picture, we have some solid contra signals in bearish sentiment and positioning, which, you know, we talked about with this bull and bear indicator, super bearish, which is good. We have valuations that have been compressed. Again, we just talked about that with small caps, but also in other spaces as well. And we've had consecutive breadth thrusts following capitulatory selling. Capitulatory, what a fun word to say. And what are breadth thrusts? That's when you see a bunch of stocks moving up together. Because what do we want for a strong run in the market? We want all the stocks moving together, not just a few dragging the market up and dragging the laggards behind it. So you can measure that by looking at these breadth thrusts. And what we normally want to see is 3 or 4 of these in a row. And that tells us that we are at some type of bottom. That buying pressure helps solidify that bottom. And you know, if you watched our last weekly review, we talked about those breadth thrusts in detail. But we got them, so it's good. So that together is a recipe for a multi-week rally. But the only missing ingredient is liquidity, which is still really bad. For a durable bottom, we need yields to settle down. And you can see right here that yields are not settling down. This is not the best representation, but I like to look at TLT. And when it's dropping, meaning the price of bonds are dropping, yields and interest rates are going up. And when this happens, when yields and interest rates are going up, that severely hurts the stock market. So we are missing that yield factor, which is why this is probably not a long-term bottom. This is why the market's gonna turn around again. But again, bear market rallies can be pretty long. 18%, you can make some good money in that as long as you have your risk control in place, because when it turns, you know you got to get out. Here's an interesting chart that shows US CEO confidence as a lead on profits. So the CEO confidence is this darker green line, and you can see it's plummeting. And when that plummets, profits tend to follow, because who knows more about the company than the CEO? So there's no doubt that we're headed for an earnings slowdown of some sort. And what will matter is whether we get an earnings recession or just a deceleration. So our money is on just a deceleration, but noisy macro times call for weak opinions. The market is very noisy right now. And while CEO confidence may be in the dumps, the Philly Fed Stay Coincident Index is as good as it gets. It shows increasing economic activity across all 50 states. And you will see this start trending down well before any economic recession. So this is something to watch, and it's looking great. So again, different data points here. And talking about valuations once again in the market, here's a good little piece from Mr. Blonde Macro. He says equity valuation compression in the last 6 months is meaningful, and now it finds itself in the pre-COVID average range of 15 to 18x. Now, is that too high? Well, yeah, probably considering the macro conditions of inflation and the Fed rate hikes, but it's also come a long way from the 22x that we were facing last year. And at least from a tactical trading standpoint, meaning short term, valuations undershot the -2 sigma band, and they undershot it by amounts similar to past corrections, which brought a pause in the pain. So this is more data showing that yes, we have some temporary relief in the market. So going back to oil, crude oil does not look like it's going to stop rising anytime soon. If you look at this chart right here, this is of the futures in crude, it's entering a parabolic run, which is not good for our gas prices. But speculative positioning is coming off low levels, and seasonality is good. China is also opening back up, which doesn't hurt because they use a lot of fuel or oil. So we are going long crude right now, and we're adding to our position on pullbacks and consolidations, but this looks like a massive run. And if you're looking for a way to play it in the equity space, Laredo Petroleum is looking pretty good, LPI ticker symbol. It's an Oklahoma-based E&P that trades for roughly 3 times next year earnings. This is a monthly chart right here, and you can see that it's breaking out from this cup with handle pattern. And cup with handle patterns are interesting because what happens is you see a lot of selling and a bottom form right around here. And you can see right here, you see how tight these little bars are? That's telling you it's at the bottom because the sellers and buyers are kind of in equilibrium. So what happens is you get a few months of this, actually this is many months, and this is kind of the base period, right? And then we start to move up higher, and this forms the right side of the cup. And then we break out, but what happens? Things stall out again because a bunch of sellers come in at this point, and this is where the handle forms. And once those sellers clear out, because all we're doing in these patterns is clearing out the weak hands, so once those sellers are gone and then we get a breakout, that's a very strong pattern because you had just 2 periods where all those sellers were getting cleared out. Here at the bottom of this cup, and then with this handle after the cup has been cleared, because this handle only forms after this cup. And normally the handle actually slants lower because prices go lower as there's so much selling, but this one stayed pretty tight. So this is a great breakout right here in this name. And you can see right here, I'm looking at it from a daily chart. It just rocketed out of that consolidation. So at this point, depending on your strategy, you know, you could jump in right now, or you could wait for it to come back and kind of kiss this line, which these stocks often do when they have such a strong breakout. But really it comes down to what your strategy is. Because right now, what is it, like 12% above that breakout period? So you could wait for it to come back and kiss, because we love kissing charts, or you could just wait for it to consolidate again. But overall, this is definitely a strong one to add to your watch list. Just got to manage when you get in and out, as always, because trade management is always way more important than stock picks. Of course, when you put them together, you're going to get the best result, but trade management always trumps it because trade management turns into risk management. Again, the #1 thing. And yeah, we'll see what happens with this market because this little consolidation, it's, you know, the market's not moving much. It should break higher, but who knows? And what I like to watch is the stocks in my portfolio because they are the highest momentum stocks. And you know, we just made a rotation in the Fallible strategy at the beginning of this month. And I'll tell you right now, those stocks that we got into haven't moved much. And that's kind of a signal of where the market is going because those are the strongest stocks. So they're kind of still basing. And again, you look at the general market, yeah, it has pretty much been basing since the beginning of the month. And again, this is very, very short term, so you don't really know what's happening right here. But when I look at these leading stocks kind of not moving either, that gives me some pause. But again, it's a very noisy market, so the only thing you can rely on is your risk management. And there is nothing wrong with going fishing during this time because like we said, there are a lot of beat up stocks and you could add those to your watch list. You could add in small positions. It's a good time to do it, but be careful. And in our last video, we actually talked about one of these really beaten down industries and a particular stock that we're looking at in that industry. I'll link to that video right here. You don't want to miss it because it's definitely one that you want to add to your watch list. So click this video right here, go watch it, and then turn off your computer or your phone and then go watch Top Gun. And I will see you in the next video.